So for the second consecutive quarter, we saw that international equities actually underperformed domestic equities. Last quarter, I believe you said that that was due to currencies. Can you talk a little bit about why this quarter international equities struggled compared to domestic equities?
Well, it was currencies again, but it was a different move. So in the first quarter, we saw currency appreciation overseas. So that was a bit of a headwind, particularly for the export type countries, as a higher currency makes it a little bit harder on the export side. What we saw in the second quarter was the complete opposite. The dollar appreciated over 5% against international currencies. So we had a strong rise in the dollar. So if you actually look at the international equity index in local currency terms, it was up 3.5%. It actually outperformed the S&P. When you adjust for the currency depreciation, it was down 1.25%. So really what you saw was reasonable returns for foreign investors, but when you bring it back to the United States, the currency appreciation of the dollar caused us to see a loss on international investments. So not great. What caused the currencies to fall was really a couple things. Interest rates in the US are getting higher relative to international markets, and higher rates tend to attract capital, which tends to raise the value of the dollar. And we also saw the situation in Italy, where we had some populist officials elected, and the probability of maybe Italy defaulting on their debt or even leaving the Eurozone increased, so that put some weakness on the euro. And then Japan had really a pretty bad first quarter from a GDP standpoint, and we saw the yen depreciate. So it was really the depreciation of foreign currencies that impacted international markets the most. And it's even worse if you look on the emerging market side, where you had an 8% decline in the emerging market index. And countries like Brazil, for instance, the real depreciated 17% in the quarter. So it was almost all depreciation of currencies. And again, that tends to be a combination of the tariffs kicking in and the thought that maybe some of these countries will be negatively impacted. Their currencies went down. Strangely enough, Mexico and China actually were among the best performers. But nonetheless, emerging markets are definitely in the crosshairs of this tariff talk. And it definitely impacted them negatively and pulled down most of the currencies.
Thanks, Darren. And thank you for joining us.